Everyone is obsessed with interest rates when buying a property or when it's time to renew your current mortgage. But focusing on rate alone could be the most expensive mistake you make when searching for a new mortgage. And of course, your interest rate matters, but it's really only one piece of a much larger puzzle. And there are other parts of your mortgage that can have even bigger impacts on your long-term costs, flexibility, and financial future. But the problem is that most borrowers focus on the lowest rate possible because, well, that's the easiest part of your mortgage to understand. Then after you sign your life away with a whole bunch of fine print, which isn't a problem until it is a problem, which it very often becomes. Because when life just seemingly happens and you have to, I don't know, maybe sell early, refinance, or even change lenders, those mortgage holders who only focus on rate, well, they find out the very, very hard way what really matters in your mortgage. I've seen clients over the years get hit with absolutely massive penalties, nasty prepayment terms, the complete inability to sever the loan if they choose, or worse, they've gone into bankruptcy, all because they thought the best rate was the best mortgage. And that is simply not the case. So in today's video, I'm going to share with you all of the small print details that could be lurking in your discount mortgage that are way more important than you think they are, and they could be and likely are more important than the interest rate that you're being charged. And my hopes are that when you learn about what you should be looking for within your mortgage, that you can then save your future self thousands of dollars and hours of heartache. And that will not only have you clicking the like button for the YouTube algorithm, but it will also make you look super smart in front of your friends. And then ideally you could tell them that you learned that info here on this channel, and they can then also subscribe. And then maybe, just maybe, if you or your friends in the future need real estate help, well, you could both book a call with me using the link in the description below. So we can have a call and I can share with you how my team may be able to help you. Now, let's start with what might be one of the most obvious terms other than rate buried within your mortgage. And that is whether or not your rate is fixed or variable. Now, when you get your mortgage, you're going to pick whether or not you're going to go with a fixed product where your rate has no chance of changing for the period of time in which is set out in the contract. Or you may go for a variable interest rate. A variable rate is just that. It can vary. These types of mortgages are tied to the Bank of Canada's overnight lending rate. So if you take a variable rate, you might be delighted if the Bank of Canada's next meeting announces that rates are going down. They might stay the same, or you could see your payments increase due to rates rising. But also in the variable rate club, there are two different types. One is called a static variable, and the other is an adjustable variable. An adjustable is exactly that, exactly what you think it is. If rates go up, so does your payment. If rates go down, so does your payment. But a static variable means that if your rates go down, your payment stays exactly the same, but the length of which you pay back the mortgage actually gets shorter. And yep, if rates increase, your payment does not change, but the amount of payments or the length of your loan that you have to make over the life of your mortgage increases. And that then brings us to amortization. This means how long is the life of your loan. Typically in Canada, amortizations are 25 or 30 years, but they can be less if you can afford the higher payments. Often people sign up for a 30-year mortgage and they don't even realize they have the ability to pay off the loan faster if they choose. And the reason they are never told this by the mortgage broker or the realtor involved is that a 30-year loan lets you qualify for more loan and a bigger purchase price. Now, there are different rules whether or not you can exceed 25 years and go all the way up to the 30. So this will depend on your specific situation and if you qualify for the longer, larger loan.
Nice alliteration.
Next, let's talk about the term. Often confused with amortization, the term is not the life of the loan, but rather the portion of the life of the loan that you will commit to the current interest rate and style of rate that you picked that I mentioned earlier in this video, the fixed or variable. Traditionally in Canada, almost everybody chose 5-year fixed rates. This meant that you were locked in for one rate for 5 years at a set amount. This then offered you security knowing that your payment would not rise for at least 5 years. But these fixed rates can also be offered in 1, 2, 3, 4, 7, and 10-year terms, of which lately the 3-year has been quite popular, often because it's the lowest rate that's been offered by the banks. Or on variables, the terms could be totally wide open with no term at all. But often, again, 5 years is the most common, but a whole lot more risky and potentially way more beneficial if you're able to get a lower rate and pay down the mortgage faster over time. Now, all of these terms that I've mentioned, except for maybe the open variable, will come with penalties if you break your mortgage early. So if you want to move or refinance in, say, 3 years into your 5-year term, the bank is going to hit you with a portion of the interest that you normally would have paid if you had carried out the loan all the way to the end of the term. This might be the most commonly and costly mistake made in exchange for a low interest rate. And unfortunately, you may not know how bad of a decision you made until years down the road. So pay attention right now. If you have a variable rate product, your penalty is likely only 3 months worth of interest at most banks. This is generally a great option if you are okay with the risk of a variable rate product, and if you think you may have a high likelihood of moving within the next 5 years. But fixed rate products of 1 to 5 years have penalties calculated off of something called the interest rate differential. This is a calculation of how much money you would have paid in interest against something called the posted rate, which is seemingly just a made-up number from your bank. And while I have seen these penalties be as little as maybe $3,000 up to $25,000, and I've heard of horror stories of them being way higher. Now, there is some saving grace. Different lenders have different penalties for different fixed rate products. Big banks are often usually the worst, and non-bank lenders can be a little bit more forgiving. But also, if you take a 7 or a 10-year product, lenders do not charge a penalty after the first 5 years. But I've never actually seen anyone take a 7 or a 10-year mortgage because the rates are just so much higher than on those lower term mortgages. Now we're going to get into a few more, much more obscure finer print terms, if you want to call it that, but they are very, very important because they may come back to bite you. Most mortgages allow you to pay more than what you had agreed to as your minimum, but not all of them do. So be careful. Let's say you get a raise at work and you want to increase your payments. Most mortgages do allow you to increase your payments, sometimes up to double. This is a great thing, but my personal mortgage at Manulife does not allow for this at all. The only prepayment they allow me to do is what is referred to as a lump sum. So I can pay extra, but not in scheduled amounts by increasing my current payment. I have to save up that money in a different account and then pay it down as a lump sum whenever I like or whenever I'm able. To make it more confusing, some institutions only let you pay those lump sums on one specific calendar day of the year, the anniversary of your loan. It's stupid, but I've seen those loans out there. And you have to be careful with lump sums and all prepayment increases that you make, because these lenders will actually have a maximum of how much you are allowed to prepay, often somewhere between 13 and 20% of the original amount that you borrowed. I mean, this is a really good problem to have, but if you overpay by too much, you could trigger those penalties that we spoke about earlier. Now, these last 3 terms are really, really obscure, but trust me, I have seen absolute horror stories connected to each one of them. And again, the buyer that was solely focused on interest rate then blames the bank for not knowing about these terms that smash them financially in the future. Starting off with something called the bonafide sale clause. This means the only way to break the mortgage is to sell the property at an arm's length transaction, what they call a realtor to realtor sale on the MLS. No, if you have this type of loan, you cannot refinance if you need to, and you cannot switch lenders for a better rate until the end of your term. The only way to get out of a mortgage with a bonafide sale clause is to sell. And that might handcuff you in the future if you need to borrow some more money, or if you want to, say, switch lenders in order to take advantage of a lower rate in the future. Maybe you want to switch products to something like a home equity line of credit. And in reality, borrowing more money is probably not something we want to do, but maybe you had an opportunity that came up to buy a rec property, an investment property, or start or invest in another business. Well, the bonafide sale clause could definitely get in your way of refinancing. But then again, so could the amount of your mortgage that the bank registered it for at land titles. You see, when a mortgage is registered onto a property, it's set out as being a certain amount. So if you buy a property for $500,000 and you put 50% down, or $250,000, you would think the land titles would show that you owe on your property $250,000. Well, most often these days, lenders will register the charge at land titles to the full purchase price. The bank will try to sell this to you as a positive. After all, if you need more money, just come back to us in the future. We can lend you up to 80% of the current home's value, and we don't have to go back to land titles and worry about registering things again. But in reality, if you owe $250,000 on a $500,000 purchase, and the bank registers the charge for the full $500,000, which again, you signed for and agreed to in the fine print, then the bank is essentially clogging your title, meaning that you can't go to any other institution or lender to borrow more money against your property unless the property value goes up over and above the registered amount. Again, handcuffing you to a single bank. But if you want to know the worst case of being beholden to a single bank, it's called the total indebtedness clause. Essentially, what total indebtedness means is that if you have other debts with the same bank, maybe an RRSP loan, a car loan, credit card, or unsecured line of credit, or maybe even a business loan, and you miss a single payment on any of those or your mortgage, well, the bank can then wrap up all of that debt into one debt and even foreclose on your property. This is the wildest small print term that there is. And you can check out this video right now if you would like to learn more about how absolutely terrible this last term can be and why it could cost you way more than you think, and why it's way more important to understand than the mortgage rate that your bank is offering.